Good morning. Marc Ostwald from ADM Investor Services International with some thoughts on emerging markets, assets and foreign exchange. But before that, and partly because this is what it's predicated on, a couple of thoughts on that reaction that we had yesterday to John Williams' speech in New York about, well, he was basically ruminating on the long-term lessons that have to be learnt over the past 20 years about how to conduct monetary policy, to which the market have now basically responded by ascribing a 47.5% chance, as one can see from the attached table, to a 50 basis point rate cut at the meeting in July. What can one say? He wasn't really talking about current monetary policy, as the New York Fed had to clarify. But nevertheless, we've come back somewhat from the 59.5% chance, but that looks inordinately high, particularly given the run of economic data that we're having at the moment. But to turn my focus to the topic in hand, which is emerging markets and whether a Fed rate cutting cycle is going to be good for them, let's just have a run through what they actually look like at the moment, starting off with a comparison of the US dollar index against the US dollar index versus emerging market currencies, which is my first chart. As one can see, after being hugely overvalued at the beginning of last year and taking a huge shock as we suddenly realized that the Fed was very serious about implementing 4 rate hikes last year, emerging market foreign exchange or currencies took a huge tumble. And as much as there has been some recovery, it's not exactly been immense relative to the point where we were at this time last year. So it would appear in the current, from the current perspective, given that the Fed is likely to be certainly cutting rates by 25 basis points in July and dangling the cherry of another 25 basis points, of which I would only observe it's probably going to be better to travel than arrive, but nevertheless it will still be out there. So what about a comparison of actual asset classes in emerging market currencies? Let's start off by having a look at the next chart, which is the MSCI Emerging Market Stock Index relative to the S&P 500. Yes, again, here we are in a scenario where it took a huge tumble through much of last year, having got hugely overvalued at the start of the year, but has definitely lagged very heavily relative to the S&P 500. What happens if we have a look at the next chart beyond that? This is the JP Morgan Emerging Market Bond Spread. This is the index of non-domestic government bonds, i.e. dollar-denominated or euro-denominated, mostly dollar. And we can see that basically the spread has actually tightened quite significantly this year, but we are still a very long way from the overinflated levels that we were last year. This is sort of like an alternative to where we were. And I think the simple message on that one is that what we're looking at is a scenario where probably on a very selective basis, we need to start looking rather more closely at emerging market assets. I think the simple thing is to remember that when we look at all the array of rate cuts that we've got due in the next week, Russia and Turkey. Turkey is basically coming back from ultra high levels, as was the case with Indonesia this week on a relative basis, and indeed as was the case with the Ukraine. So it's not really above all about the dollar, it's more about specific situations. So be selective when you're looking at these emerging market assets, and remember those ones which are likely to be included in future indices as we go along. So the GCC countries and indeed China look to be those sort of ones where either in bond or equity terms one might need to be investigating this somewhat more closely. And that's it for this week.